Diversification is often seen as a one-time setup. But in today's market, it needs to be more dynamic. A good portfolio isn't just built for today. It's designed to adjust as things change. And that's where the real value of diversification begins to show. In this episode of Nivesh Pe Charcha, the Diversification Playbook, we are going to explore building portfolios that can adapt over time. And joining us is Ms. Afra Netto, financial advisor at Netto Investments, Mumbai. With experience managing portfolios across Indian and international markets, Afra brings together practical strategy and behavioral understanding. Her work focuses on helping investors make choices that reflect their goals, while also preparing their portfolios for a world that does not stand still. In this conversation, she talks about what real diversification means, why asset mix matters more during market extremes, and how structured strategies like multi-asset funds can help reduce complexity while supporting long-term goals. Let's begin.
Afra, thank you so much for joining us on Go ANC today. And I want to dive right in and ask you about portfolio construction. When you first think about it today, what has fundamentally changed in how investors approach it?
So today, actually, we look at it, investors are managing this very complex and volatile, interconnected world in which they have so much of knowledge on their hands. Investors are aware that the traditional 60-40 portfolio nowadays won't work. They are trying to see how they get better returns. At the same time, they are able to manage risk because it's not only the returns, right? They also are worried about managing risk. Also, they find that the portfolio should be in a way that, they can, sometimes it's a personal goal that they have, like ESG. If someone is aligned towards that, they can look at those kind of portfolios.
So diversification is often misunderstood. As per you, what does it actually mean to diversify the right way?
So real diversification, if we are looking at it, is not putting all your monies into a similar kind of a fund, right? So if you're taking it, you'd have to think about assets in such a way where there's stocks, there's bonds, there's gold. There's also some kind of real estate maybe, right? For example, if you hold everything in one kind of an asset, then when the market crashes, your asset, your portfolio is also crashing, right? So true diversification, if I look at it, would mean balancing uncorrelated assets in such a way that it will respond differently to an economic scenario, like inflation, for example. So in such kind of a portfolio, you won't have so much of a downfall. So in that kind of sense, you are avoiding concentration. So that is a diversified portfolio, if you ask me the question.
And what typically happens when investors build portfolios around just one or maybe two asset classes? What are the unseen risks here?
So when people build, and I think most people look at it and say that, okay, equity and debt or bonds is what is my portfolio looks like, right? Without broader diversification, say into commodities or gold, investors have a little cushion. So keeping in mind that we have to make sure that portfolios are diversified well.
Okay. And do you think people fully realize how differently equity, debt, gold, they all behave, especially during market extremities, highs and lows?
I think most people don't. We tend to, in calmer markets, everything's moving up. Everyone's very happy and everyone thinks that's the way it should be. And that leads to a little bit of complacency, right? People don't look at diversifying their assets. But during extremes where recession happens, or inflation spikes happen, or geographical situations happen, that's the time these assets, if your portfolio is not diversified, will affect you. So in that kind of a scenario, it's very important to have a diversified portfolio. Understanding the unique risk return profiles and behavior patterns is very important, even under stress. And that is very important for proper portfolio diversification.
So according to you then, what behavioral biases tend to pull investors away from maintaining a balanced and diversified mix over time?
So, I have noticed in my discussion with investors, many investors tend to chase recent winners. They look at the market and they think, okay, they think like, yeah, acha, this fund is good. I must invest in it, right? So they do not look at risk profile. They do not look at what is there in my portfolio. So believing one can time markets is another thing. One is chasing recent winners. One is saying, okay, I'll pick the right stocks at the right time. That's another bias most people have. Or chasing trends and forgetting about the strategy that one needs to have when we are deciding a portfolio. The most common thing that I've noticed is reacting emotionally to markets. When the markets are falling, people tend to get stressed and then they may remove that money from the portfolio. And that is when these biases will affect investors, the emotional decisions.
Portfolio rebalancing is also something that we read about, we talk about, and it sounds, the concept of rebalancing sounds quite simple in theory. But why is it so difficult for people to follow through on something like that?
So rebalancing, like you said, sounds interesting, but sometimes it means selling winners and buying underperformers if you want your portfolio to do well. And that goes against basically our human instinct. Our human instinct says buy winners, sell underperformers. But that is not the way to go with a portfolio. Sticking to what I've decided. What is my discipline? I want to reach such a goal. That means, how do I do it? Sometimes I may need to sell winners, buy underperformers, right? Without rebalancing your portfolio time and again, you will not be able to achieve what you want to achieve. So sticking to a solid goal plan, being disciplined and rebalancing your portfolio will help you achieve that.
Sure. And for somebody who wants to stay diversified but cannot keep track of every market move, how can structured solutions, for instance, a multi-asset fund, how can that help in that case?
I think for people who do not have the time, do not even have some amount of knowledge, only, going by their biases of listening to what is doing well, for those kind of people, diversification is sorted by a multi-asset fund. You have professional management, you have portfolio balancing, the fund manager basically is doing your job for you. So investing in a multi-asset fund in that kind of a scenario for someone without the time or the expertise really helps.
So let's say somebody is evaluating or considering a multi-asset allocation fund. What are the key things they should factor in before they choose to invest in any of these?
So, and I say this to most of my investors too, is what is the mix of assets? Does it align to your risk level? Does it align to what your goal plan is? What is the track record? What is the track record of the fund manager? What is the track record of the fund? What are the costs? How often is a portfolio rebalanced? Is a few of the things that I would think a person should look at before investing in a multi-asset fund.
All right, Afra, it was great having you with us and speak to our viewers in detail about diversification and your insights and learnings from the market at large. Thank you so much.
Thank you.
As Afra Netto shared, diversification isn't just about spreading your investments, it's about doing it in a way that brings more clarity and control. When portfolios lean too much on one or two asset classes, the issues often show up during market stress. A thoughtful mix of assets can help investors stay more aligned with their long-term intent, even through uncertainty. That's where the Grow Multi-Asset Allocation Fund comes in. It seeks to invest across equity, debt, and commodities like gold and silver, all within a single portfolio. The fund aims to bring together different asset classes in a structured way, so investors do not need to make those allocation decisions on their own. The NFO is open from 10th to 24th September 2025. Please consult your financial advisor before investing and do read all scheme-related documents carefully. Because when the mix is designed to support your journey, it becomes easier to focus on where you are headed, not just what the market is doing today.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.